Yeah, hi Sarah. Days like this makes balanced fund investing make some sense, doesn't it? Where you want to try to offset some of the volatility of the downdrafts of markets like this.
And how are you doing that?
Well, in the balanced fund, the way you do that is you have stocks which are volatile and are usually historically, if you look at return and risk, they're up here, but it bounces around, and bonds usually are meant to have less volatility. So for the Plumb Balance Fund, what we try to do is to participate in the long-term nature of the stock market, but then moderate days like this when you have significant downdrafts, because nobody knows what day the market's going to drop this much and this quickly. But we do know that we will have those at different times, and so the key is, how do you live through those with enough reduced volatility so you can take it to get the long-term return the equity markets offer? So with that, we use bonds. I'm sorry?
Nope. Go ahead. Finish your thought. You use bonds and what else? Pardon me.
Well, bonds, that's one of the things that we try to do for us in the Plumb Balance Fund. What we want is the bonds to moderate that volatility. And so in bonds, you could take two types of risk: credit risk or interest rate risk. Often when interest rates are going up and bond prices are going down, or when the stock market's going down because of concerns about the economy, credit risk and interest rate risk aren't high enough. You don't get a high enough return to pay you for that. So what we try to do is stay with shorter term, high grade corporates, grab some yield, but most importantly, moderate that volatility of the stock market. Because the stock market is going to bounce around like this, but if you invest in the right types of stocks, we think you're going to get that return over time that you should get from the equity markets.
Okay, calming words for sure. Are you a buyer of stocks today, or are you afraid this is going to get worse before it gets better?
Well, that's a good question, and we're actually not buying any stocks today. We're watching it. But, you have cash, you have your bonds, and you have the stocks that you really feel in the future are going to be good return from today's price. So we're looking at it, we're evaluating it, we're trying to decide which ones are getting overhit by the market. But there's some really good companies today, and some of those companies are going to be the best performing stocks out 5 or 10 years from now, but they're also going to be some of the most volatile in between those time frames.